Hey guys, hope you and the families are doing well. In this video, I'm going to teach you about my 4 selling guidelines that I look to use when I'm swing trading and want to decide when to exit the position. Now, I'm going to teach you all 4 of the selling guidelines, but I'm going to teach you how to assess the character of the stock to decide upon what you think is going to be the best selling guideline or guidelines for the stock based on the previous character. So hopefully it'll be quite eye-opening for you and really help you with your trading. Market Search are today's video sponsor. They're my go-to resource for analyzing company fundamentals. If you're interested in a discounted trial, then you'll find a link to that in the description and the comment section below. So let's get straight into the video. Now I'm going to be taking you through my trade in Oklo, OKLO. So the entry is through the high of this shakeout demand tail on the 10-day EMA. Okay, if you follow me for a little while, you know about shakeout demand tails, gap down reverse bars and trigger bars. Okay, so I'm targeting the entry through the high of the shakeout demand tail on the 28th of January 2025. It's an inside bar, nice shakeout demand tail. Now I'm targeting an ORB, so an opening range breakout. I use the 5-minute time frame to do that. So my entry is at 34.25 and my initial stop loss goes on the low of the day, so LOD, by a single cent, which is at 33.26. So my entry is right here, my initial stop loss is here, so my initial risk is 99 cents, assuming no slippage when I get stopped out, which is rare, but that equates to minus 2.89%, again assuming no slippage. So that is a very favorable risk to potential reward based upon the stock's 20-day ADR percentage, which at the time of filming this video is 14.47%. Like, this is really favorable in terms of asymmetric. If you understand TML's momentum leaders engaging initial risk relative to 20-day ADR percentages. But then we get into the topic of the video, right? Because this stock here, it starts powering out the gate. Now, the way I think about trading is there's 4 main parts to every single trade. Number 1, you've got to identify what you deem is a high quality setup. Number 2 is you've got to control the initial risk relative to the potential reward. Just like I was saying there, thinking about initial stop loss relative to the 20-day ADR percentage. The third part is the risk mitigation. How do you free roll the trade? So what I did is I took off 1/3 of the position at 2 times the initial risk, and then I free rolled it. So I've got 2/3 of my position left. Then we move into the 4th part of a trade, which is optimize. So optimizing profits, thinking both in terms of the size of the monetary gain, but the efficiency of the gain as well. So that's the time value element. So ideally we want a large percentage gain, but we also want the time value of that gain to be high as well. That's why I call it the optimized part, because we're trying to optimize the profits. That's what I'm going to teach you about how to think. So when we're in that optimizing profit, okay, so we've identified the trade, we've controlled the risk, we've mitigated the risk. Now we're in the optimization part. Okay, what are the selling rules? What are the selling guidelines that we're looking to then use? Well, for me, there's 4 main ones. Okay, that's going to be the first close below the 10-day EMA. On my chart, that's going to be the black line that you see here. The first close below the 21-day EMA, that's going to be the blue line that you see here. The first close below the 50, that's going to be the purple line that you see here. The gray line is the 65-day EMA, in case you were wondering. And then stop loss, so SL is stop loss to LOD, lower day, if extended from the 10-day EMA. So these are the 4 that I'm going to be teaching you about and the ones that I look to use. So I'm looking for a first close below one of those 3 key daily moving averages, 10-day, 21-day, or the 50-day, or I'm looking to push my stop loss potentially on all or part of the position to the low of the day if I think the stock is extended short term from its 10-day EMA. Then what I'm trying to do is I'm trying to go back and assess the character of the stock. So I'm going to be taking you through the trade that I've currently got open in Oklo, okay, but I'm also going to take you back so we can assess the prior character of the stock from 2024 and also in the spring of 2024. So we kind of got Q4 of 2024, and then we got spring, so into Q2 of 2024. Okay, we're going to be looking at this. We're going to be looking at this as well. Now this goes into the prior character of the stock. Okay, so let's start thinking about the optimizing profits. Okay, so we're thinking about both the monetary gain, but we're thinking about the efficiency of the monetary gain, which is the time value element. Okay, so what I've done here, let's just say you have a hypothetical entry right here. Okay, it's kind of like a little gap down reverse bar, nice reversal coming off around the 21. Let's say you target it through the high of that bar, place your stop loss either here or on the low of the day. Okay, so your entry is going to be around here. Well, when do you sell the position? How do you optimize it? Well, for me, the best indication of how to do that, how to optimize the profits, is the stock's character. How has it moved previously? Now what you'll notice is different stocks move differently. Oklo is going to move differently differently to Amazon. It's going to move differently to Nvidia. It's going to move differently to a 100 million market cap biotech stock. It's a different stock. It's going to move differently. So what I want to do is I want to assess the character, because I hear it so many times. People say, well, I'm just going to hold until the first close below the 50-day simple period moving average. Well, very rarely is that actually the optimal thing to do if you're looking to optimize the profits. If you've already made it this far into the video, you're probably interested in how you optimize the profits. So this is how we assess the character of the stock. So let's say that you had an entry here. Now we're going to leave out the stop loss to low the day if extended until I've taken you through the moving average example. Then we'll add a little bit of complexity to when in the stock is short-term extended and I like to move my stop loss to the low of the day. Really like that technique. Okay, so if we were looking here, okay, the first close below the 10-day EMA. So let's just imagine on the first daily close below the 10-day EMA, I know it's here, I know it's actually there, but because of the big kind of shakeout demand tail before, for me, I would probably hold even though it closes below there and probably have my stop loss like here. But this is the first kind of clear where it's kind of turned down like this and it's closed below the 10-day. So let's just say this is the first close below the 10-day for this example. That's the first close below the 10-day. Okay, here's the first close below the 21-day EMA. So we're just imagining that if we had a position here, we would then exit there. Okay, at the close, first daily close below the 21-day EMA. Okay, let's exit there. And then this would be the same example with the 50. Okay, first close below the 50-day simple period moving average being the purple line, we're just going to exit there. So then if I was to ask you, well, what is the best moving average in that instance there to use as a trading stop loss? So the first daily close below, that'll then be the exit. Is it the 10-day, is it the 21-day, or is it the 50-day? Well, if you were just looking at the monetary gain, okay, so the percentage gain, you'd probably say the 10-day EMA, and you'd be right? Let's just imagine that we have an entry here. When it closes below the 10-day EMA, the stock is up around about 121%. If we look at the 21-day EMA, the stock is up about 76%. If we were to look at the 50-day, it's up around about 82%. So in terms of monetary gain, what had the greatest monetary gain? It would be the 10-day EMA. So the 10-day EMA is winning in that regard. We then also want to factor in the time value. How many days did it take to achieve that percentage gain before the first close below the 10-day or the 21-day or the 50-day? Well, again, the 10-day EMA wins there because it's doing it in fewer sessions. Does it in around about 3 sessions before the 21, and that's probably around about 3 or 4 weeks or so before the 50-day SMA close. Okay, so it's much more efficient in terms of giving you, one, a higher monetary percentage gain, but also doing in a fewer amount of sessions. So the time value is then increased. Okay, so you're just dividing the percentage gain by how many days it took to achieve that gain, days or sessions. You pick. Okay, you'll get the same answer. I use sessions when I'm calculating that. So what I'm then doing here is I'm going, okay, if I was, now I know this, okay, because I know this information before I'm taking this trade here, okay, on January the 29th, because this is what I do. I go back and I study the stocks and I create a game plan from a trade management perspective. So I'm looking at this and this is the work, this is the detail I'll do and go, okay, in this instance here, the 10-day EMA was better than the 21 and the 50 for reasons that we've just discussed. So using the 10-day EMA as a trading stop seems quite prudent for this stock, okay, Oklo, based on how it's previously moved. Now, if I were to add a little bit more complexity, okay, because sometimes stocks can get short-term extended from their key daily moving averages. Now, some stocks have a more frequent tendency to do that versus others, but Oklo has a tendency to do that. It gets a bit ahead of itself, so it runs up really quickly, a lot of momentum, pulls back quite hard. Is what the stock does. You may see other kind of momentum leader stocks with high 20-day ADR percentages also do this. So let's now imagine here, okay, we have our entry here. Now, when the stock gets short-term extended from the 10-day EMA is a very subjective exercise, okay? I cannot give you some mathematical formula that says, right, this is when you've just got to use your eyeballs and your experience to go, that stock short-term looks a bit extended, pretty V-shaped, it's gone up in a straight line, it's a bit extended from the 10-day, right? So at this point here, okay, this stock here, in my opinion, is now at the close here, okay, this stock here is short-term extended from its 10-day EMA, okay? The stock is just powered up pretty much in a straight line, okay? It's then currently up there. It's gone up around about 75% in the space of 4 sessions. 75% in 4 sessions is probably extended, right? Just a little bit of common sense. Now, I know it's not that common, but try and apply some common sense here. So here, 75, 76% in 4 sessions, it's extended, right? So what do you do in that regard? Do you just chuck it out and go, stock's extended, I'm out? Well, if you had thought that, you may be just exited here. Do you know what I mean? You may have just got stock short-term extended. So what I do is I took this lesson from Nicholas Davis. I'm sure many of you have read Nicholas Davis's book, How He Made $2 Million in the Stock Market. And what he said was, and I just think it's a golden nugget. So I like to say golden nuggets. Okay, is he said, I let my stop loss decide. And I just think that's so wonderful. I let my stop loss decide. It's a single sentence, it's a simple sentence, but it just removes so much emotional angst and emotional stress and emotional, because otherwise you're just guessing, right? You're just going, oh, maybe it's extended here or here or here or here. I just go stop loss, low of the day, all a part of the position. I'm going to let my stop loss decide. I then don't need to make any more decisions. So in this instance here, imagine on this day, if you go, oh, this stock's short-term extended, I'm exiting, or maybe intraday here, you go, oh, this thing's powered up 30%, I'm out, that's me, I'm done, I'm out. And you may go, wow, great trade, right? But then what happens if you only took, say, 30% out of a 100% move? Why did you leave so much on the table? It's then not a great trade. You did not optimize profits very well, in my view, okay? So what I would do here is just go stop loss, low of the day, stop loss, low of the day, stop loss, low of the day. So I'm just then moving the stop loss to the low at the daily low, and then the exit would be somewhere around here, up here somewhere. Nice, really, really efficient. One, very high monetary gain, and you did it in a really short period of time, about 5 or 6 sessions. Not bad, right? Not bad at all. So you're just letting the stop loss aside. So that is the stop loss to LOD, low of the day approach, if short-term extended. This is short-term extended, okay? This is short-term extended, as I'm going to teach you as well. This is short-term extended as well. So you're trying to get a feel for the stock, okay? Now, some stocks don't do this. They don't trend like this, where they kind of run really quickly ahead of themselves and then they turn back around. Like some stocks don't move like that. So the low of the day approach may not be optimal based on the previous character. This is why you've got to assess it, okay? But when you're assessing it, you're going, okay, 4 basic selling guidelines: close below the 10-day, close below the 21, close below the 50, stop loss to low of the day, all or part of the position, okay? Depends on the stock, whether you want to try and keep some back for the 10-day EMA, depends how extended it is, depends on your view of the market. You could bring in some moving average breadth readings as well. Are they overbought? Are they oversold? Okay, what is going on in terms of the group, in terms of the theme? Are they still acting well? So on and so forth, right? Okay, you've got to apply a lot of common sense and do a little bit of work into this as well. But if we now go down to this example here, okay? Now this is where we got very kind of skew if, right? In terms of, let's say you have an entry here, it tightens up quite nicely along a clustering of key daily moving averages, and it starts running like this. Okay. Now imagine if you went, right, I'm just going to exit, or let's wind it back a little bit, Jack. Let's wind it back a little bit. Let's say that you were doing the same analysis here. Okay, so we're doing the same analysis and we're going, okay, we've got these 4 basic selling guidelines. What would have been optimal? Now, invariably, it's a combination of 2 of them. Oftentimes, I'll employ 2 of these selling guidelines on a stock. I'll try and select, okay, what do I think are the best 2? So in this first example here, first close below the 10-day is going to be high up there, and low of the day, low of the day, low of the day is also going to be up there as well. So for me, the low of the day approach and the 10-day EMA are optimal and better versus the 21-day EMA and the 50-day simple period moving average, and selling on the first close below those key daily moving averages. Hopefully you would agree that thinking, okay, close below the 10, low of the day is best there. If you're thinking about, again, the goal here is to optimize profits, monetary gain, efficiency of the monetary gain. Okay, efficiency of the monetary gain. That's what we're then trying to do here. So if we were applying that same process to this example down here, first close below the 10-day EMA is here, first close below the 21 is here, first close below the 50, you would have just got stopped out. Okay, if your entry is here, you're getting stopped out. Okay, is going to be down here. So the 50 is just an absolute no-go, right? No-go there. If we were to look at the 10-day EMA and the 21-day EMA, okay, the percentage gain is about the same. Let's just say, for the purpose of this, the first close below the 10-day and you exit at the close, okay, a couple minutes to go, is 17%. The 21-day EMA, let's also say, is about 17% as well. However, why is the 10-day better than the 21-day in this instance? The monetary gain, the percentage gain is the same, but what does the 10-day do that's better versus the 21? Well, it does it in about 2 weeks, 3 weeks sooner. So the time value is much higher. Again, you're dividing the percentage gain by how many sessions it took to achieve that. So in this instance here with Oklo, I'm just eyeballing it, but it probably does it in 10 to 12 sessions fewer than the 21-day EMA for the first close below the 10-day relative to the 21. So the 10-day, if you were just ranking them against the 21 and the 50, you'd say 10-day is best for the size of the monetary gain and the efficiency of the monetary gain, 21-day is second, and the 50-day is clearly third, okay, because you would just got stopped out down here. However, is there another approach? So here we go, stop loss to LOD if extended. So again, this then helps you to go, on this day here, you may have just gone, stocks extended, or on this day here, you may have just gone, stocks extended like this with the sound effect as well, because maybe here you go, I'm up 14%, 13%, 40%, that's me, I'm done. Snatching at it, I'm taking the win, I'm up 13% in 4 sessions. Aren't you a genius? Well, then look what happens. The stock then powers up here and then goes up to top. I'm not saying you're going to top ticket, but it then goes up to about 60%. So what you did there by preempting and exiting because you thought the stock was extended is you then didn't then even give yourself a look at further upside. That's what the low of the day approach can do as well. It just gives you a look at further upside. Then, okay, maybe you then want to kind of panic out up here and take some off. Okay, maybe that may be prudent. Maybe it's not. Maybe it is. But what I'm trying to say is don't panic out of the position with a little snatch at a little gain and go, oh, I'm up 15%, I'm up 20%. Oh, look at me. You don't need to do it. Okay, had you just employed the stop loss to LOD approach here to low of the day, stop loss to here, 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 and then you get stopped out right here on the gap down here on this clear kind of change of character. And there was a really big change of character the day before that as well. Okay, you see that? So that would have been really, really effective. One, it would have given you a higher monetary gain, okay, than the 10-day EMA, and it also did it in about 2 sessions fewer than the 10-day EMA. So in that instance there, if you were going to rank them, we would say this stop loss to low of the day would be number 1, 10-day EMA would be number 2, 21-day EMA would be number 3, and the first close below the 50 would be the 4th best. And it would be pretty much the similar here. Yes, the percentage gain is a little bit less going stop loss to LOD, but it does it in about 15 sessions fewer. So I would still say this would be number 1. This would be number 2, this would be number 3, this would be number 4. Now, I will do this exercise. I won't go back and do it 10 times again. I've been doing this a little while now. I can kind of eyeball it pretty quickly and go, okay, stop loss low day would have worked better than the 10-day, 10-day better than the 21-day. So it doesn't take me like 5 minutes to do this every single. It takes me like 15 seconds or something like that. Okay, just to wind back and just go, okay, my entry would have been there because I'm pretty specific in terms of where my entries are, trigger bars, gap down, reverse bars, shakeout to tails, and all of that good stuff, right? Okay, so I can pretty much just wind back a chart and go, okay, entry would have been there. Yeah, it would have been there. Okay, 10-day better than this, then right, like this. But in these 2 instances here, what you're doing is you're being quite objective here and going, okay, what is best based on the character of the stock if you're employing these 4 selling guidelines. So for me, in both instances, I'm going, okay, low of the day approach is probably number 1 in both instances, and the 10-day EMA a clear number 2, and certainly better than the other moving average selling guidelines. So what I want to be doing here with Oklo is low of the day approach and 10-day EMA. Okay, so with Oklo, when it starts getting extended up here and extended up here and here, what I do is I just go stop loss, low of the day, low of the day, low of the day, low of the day, low of the day. So then I get taken out a third here. Okay, and now a nice reversal off the 10-day. I had a really good, what I call an Immorello setup off the 10-day EMA. Okay, yesterday I'm filming this on the 13th before the market opens, and now I'm still in with a third. Okay, of the original entry here, because now I'm just trailing this 10-day, looking for the first close below. Really, really simple. Okay, really simple, not that kind of rocket science. But again, what I'd emphasize here, just to wrap the video up, is different stocks move differently. Okay, Oklo is going to move differently to Nvidia. Nvidia is going to move differently to Microsoft. So what you got to do is you got to go back and assess the character of the stock and go, okay, what is going to be best from the type of setups that you trade? They may not be the type of setups I trade. Okay, but if you're then looking to swing trade, okay, and ride those shorter to intermediate term trends, 10-day EMA, 21-day EMA, 50-day stop loss to low of the day, if and when extended, doesn't have to be on all the position, can be on part of the position, but do that exercise and then come up with, okay, what do you think are going to be the best selling guidelines? And maybe it's a combination. Oftentimes I find it's a combination. I want to use around about 2. Okay, sometimes I'll use 3 if I really want to kind of hold some along the 21-day or something like that. But oftentimes it's 2. So yeah, I wrapped the video up there. Hopefully that video was useful for you in terms of thinking about swing trading, thinking about selling guidelines, thinking about optimizing profits, and having a more kind of objective way to be assessing what selling guidelines that you want to be using. So thank you very much for watching the video. I appreciate it. Thank you very much for supporting the YouTube channel. And as always, I look forward to seeing you in a future video.